All right. Good morning, everybody. So we do get the minutes today, but the Fed has had a lot of Fed speakers since the FOMC report, and we have to kind of believe that everybody's got their view across. So for those people looking at the minutes for a little bit of insight on who voted on what and how close the numbers were, they're not going to get a lot out of that. But the Fed uses dot plots. They reference this often when they talk about the tools that they use, and those dots represent data points. So the FOMC minutes is going to provide clarity on the data that they're using and what they're going to be looking for to make their next decision, right? Of course, Powell talked about that too, but having it more detailed and more nuanced. The minutes are not just some stenographer sitting in the meeting writing down everything that they say. It is a prepared statement that has added data points to it, right? So it's a fully formed data package that's coming out today with a lot of information, and the computers are designed to parse through it really quick and then trade off of that as well. So we have that on the table. Bloomberg was talking about today being a little bit of a data dump, that there are a lot of data points coming out today, and there's very likely going to be a little bit of volatility. Not a surprise, right? We've seen that in the weekly expected move measurement, that there was more volatility in this 4-day week than there was for the entire 5 days of last week. So we know that there's an expectation of volatility. Mining and energy was at the forefront if you were to look at what happened in the overnight hours around the world. Now on Thursday, there's going to be European federal minutes released, just like we have the Fed here with the FOMC minutes. In Europe on Thursday, they're going to release those minutes. So we're going to get a lot of data over the next few days that could very likely change the course of how we end the year in 2022. So it's a really big deal. And I had been writing over the weekend and pointing out this week that with that doji that we ended the week on last week, we were in a situation where it's going to be a make or break, right? That if we break to the upside above last week's high, that we're likely going to finish rallying into the end of the year. And that if we were to break below last week's low, then we're likely to end the year heading farther to the downside. But like I pointed out before, it's not just the idea that we move down below those levels or above those levels. We have to close beyond that level for it to count. So it's a really pivotal week. And as you can see, we're still inside that range. So no answers yet, which is not a surprise, because the base case argument all week was that we were going to hold the line until we got our data from Wednesday. Well, it's Wednesday. We're looking for our data, and we're very much looking to leave this range today. There is a possibility, we always want to mention it, that the data comes out and nothing happens. right? We don't actually have to go up or down today. We could just stay sideways and go into the close and then see action on Friday. The reason I bring that up is it is a fair data point, right? We never want to say that price can't do something. And the data could be so complicated and muddy that even the algos don't trade it, and everybody just kind of waits and says, we're going to let the nerds deal with this one. And then it gets sent upstairs and, everybody crunches through it. And then they come back with a more informed decision about what they want to do going from that point. It's possible. I don't believe that's going to happen, but, it's worth mentioning. So don't believe that this is some binary event where it has to go up or it has to go down. There is a third choice. Volume is a little light this morning, not below our metrics, and it's understandably light. So nothing of concern there. So we turn it off. Right? It's really just as simple as that. Most of the time, indicators don't give you a signal. Not just that one, but indicators in general, most of the time are not giving you a signal. The trick is to figure out when it is giving you a signal. All right, so I had that beautiful move yesterday, which I wanted to point out how our tools that we use to normally define a really great trend day or a really great trading opportunity were failing to do their job yesterday, which is fine. Nothing is supposed to work 100% of the time, but I haven't had a great opportunity to point out what it looks like, right? Because we know what these tools are, the benchmarks on them for good trend and good days. What does it look like when it doesn't do its job? So here on the weighted AD, we barely got above 500 after 3 o'clock. So we were already in power hour. It was that last leg, that last little hurrah. It did not get into a trigger to go long all day. Most of the time, this thing will do a really good job of telling me that there's enough breadth in the marketplace moving in that direction that it's a solid trade. Right? Like, I don't want to go long in a directional trade unless we're above 500 or below 500. If we're inside of that, I'll still trade, do non-directional trades, iron condors, butterflies, credit spreads. But if I want to buy a call or buy a put, take a directional trade, I really want this thing out of the box. And we never got out of the box yesterday, or by the time we did, we were already in power hour and I didn't want it. So nothing's perfect. No indicator is going to always work. Another thing that we didn't get yesterday was confirming bullish signals. If we get a good, strong move to the upside, we should be seeing at least 800, 750, 800. We should get out of my colored box there, that green colored box. And if we get a tap into 1,000, that's even better. For a bearish move, we'd want it down below the red color box, right? Below 750, below 800. These are confirming signals. We didn't have even one yesterday. So the ticks weren't there. The breadth wasn't there. And the market just kept on grinding. But I will also argue that it wasn't a really good trend, right? It was a lot of consolidation, one leg up, a lot of consolidation, and then an explosive end into the end of the day. That's what they call just a melt up, a grind. These tools aren't designed for that. So it sucks if you're looking for valid signals that you use to trade on a day-to-day basis, and then there is no signal and you just watch it grind higher and higher and higher. It sucks. Doesn't mean you can't trade, but if those are the metrics that you use, you're gonna have to find something else that day. So it was worth pointing out. We haven't really had an opportunity to give a great example of that until now, right? And the only way we get better at using these tools is to show clear examples of solid trade signals and clear examples of when there was no signal, when it maybe would have been cool to get one, but we didn't get any. The breadth yesterday, if you look at the S&P, it got above the 50% mark, and that was really about all. You know, it just kind of lingered around past that. I'm sure it kind of drifted back up again in the last little bit, but go away, Siri. But other than that, it wasn't like we were stuck across the top, right? We didn't have really solid breadth in the NASDAQ. We continued to grind up, right? It took a lot longer in the NASDAQ to get there. But it did eventually, you know, get up into some positive territory that would have been a great signal earlier in the day. Monsters of Tech did not break outside of yesterday's range, so it managed to rebound to get back inside the box, but it couldn't break out of the top. Same thing with finance. Finance gapped up yesterday, set a high, and then it never made it above that high again. So we didn't have finance, which is one of our trending sectors, and we didn't have the Monsters of Tech, which is weight-wise way more powerful than all of the other 490 names in the S&P 500 combined. The only thing we had was XLK, technology sector. And it wasn't the Monsters of Tech per se. It was all the other tech names. So this is a great example of the problem that we have with the Monsters of Tech. We can have 490 names in the S&P going down, but if the Monsters of Tech are going up, the S&P is going to go up because those 10 are big enough to just bully the rest into doing what they want. On the other side of that, if those 10 names don't necessarily crash and burn, but they don't really participate in a rally, kind of hang out and go sideways and recover and just kind of languishing sideways, the other 490 names can actually move our market higher. Grinding and chopping and struggling the whole way, but move higher. So that was where the disconnect really came in from. And it's why the breadth tools didn't work. So we're really muted this morning. We have a very narrow initial balance, which implies that there is a lot of work left to be done today. If we had a really big initial balance, it would kind of imply that all the work had been done. So not much of a surprise that everybody is now waiting to trade the results of the data that comes out, and that we're not really getting a lot of movement until then. That run was a good size run yesterday, but we're still inside the box, right? Like I pointed out, if you look at the weekly range that we had been working with, we're still inside that doji candle from last week. So the base case argument is still there. This morning, however, or through the day today, leaving this range is going to be key. So yesterday I was able to call the reversal off of the lows because it didn't match the narrative that we had been focused on, right? And the words that I used was, hey, the NASDAQ is breaking down below the lows of yesterday, and it's not supposed to do that if we're going to hold the line. This is a great place to go long. That was at 9:45 yesterday morning. But now the argument goes in the other direction. Until we get the data points, we should not break out of the top of the range. We should not begin to expand until we get the data. So if we make it to the top of the range before then, very likely going to just reject and reverse and not continue the expansion beyond that breakout zone. The rig count really doesn't have any anticipated impact. It could, right? If they came out and said that we no longer have 180 rigs running and instead we have 60, I'm sure that would cause a stir in the market, but they don't just pop rigs out, right? So we're not going to change how many rigs are running on an increase very quickly. They can pull some out of a field and dust them off, but getting the fleet above 200, nah, probably not. Right. So most of the time, the rig count's not going to be an issue. Certainly keep my eye out on the natural gas report and the petroleum status report. This is a direct link to inflation and with diesel shortage and just the entire situation with what's going on in energy. Definitely want to keep your eye on that one. So 1030 is the status report. And then we have additional auctions today. No late auctions though. So by 11:30, we'll have all of the auctions that we're going to get. And that just leaves us looking at FOMC into the afternoon. I don't run 0 days in the afternoon when there is afternoon economic events, right? Like a 2 o'clock Fed meeting or something like that. I just don't do it. There's other things that I can do, right? There's other trades that we can take besides doing a 0 day in the afternoon on an event day. So with all of these events in the morning, nearly every single hour we have an event. And then in the afternoon with a late event like the FOMC, today is not a good day to do a 0 day. I think where a lot of people struggle with that 0 day is they think that they should be able to do it every single day just because they now have options that expire every single day. And options can be traded in a probability basis. So, you certainly could just lean on the probabilities that say you're going to win based on whatever probability you want, right? You want to win 80%, 75%. That's where you build your position. I'm going to argue that if you build a 75% probability trade, that means it's going to lose 25% of the time. A day like this would be one of those 25%, right? That we're in that kind of environment. So to me, it's easier to avoid a loss than it is to try to design a system that never loses, because everything loses, right? Every strategy out there has losing trades. But if you eliminate the environment where those losing trades exist, you decrease your losses. This would be that kind of environment. One more thing about those auctions, the explosive breakout yesterday, when we finally got out of that range and started moving from the afternoon session, that breakout was at 1 o'clock. It was the 1 o'clock auction that galvanized us off of that low and ran us out and through the top and kicked us into gear. Now, I'm not saying that this entire move was because of that auction. The auction was the starting point. And this is a great example of why you would not have wanted to put on a 0 day iron condor or credit spread in the afternoon yesterday until after the auction. Because with it being range bound and with it looking like it wasn't going to continue, it might have appeared to be a good idea to put on a credit spread up there. Even to be able to say, well, I'll go way out of the money and I'll put my credit spread way up here and I should be okay. Yeah, how'd that work out for you? Not too good. And yet, if you had waited for the auction and seen the breakout and seen it making that, even just starting to make that move in that direction, it would have hopefully caused you enough concern to perhaps not put the credit spread way up there, right? Or not even to put on the 0 day at all. We did get to the COG line at 40.11, which is cool. I love how just absolutely amazing those COG lines are. So I guess the question at this point is going to be, when we get the data, where are we going? Most pivot points aren't going to matter on a day like this. The explosion from the move is very likely going to just break right through all support and resistance and make its move, right? So we have an additional market maker move of 0.5%, and we have an ADR of basically 2%. So that's a 2.5% move from the close that we could go today. Let's start with the downside first. 39.26 is the market maker, or is the ADR. That's our average daily move. We want to price in this additional 0.5%, which is basically 20 points, right? It's a 100-point move if you add everything together. 83 on this one and 20 on that one, 103, close enough, right? So if you just focus on where we closed, and then you make your mark 103 points away from that, you would have priced in your market maker move and the ADR combined. So 103 gets us below the 39.11 cog line and below the previous week's low. Remember that data point? We were just talking about it a few minutes ago, breaking outside of last week's doji candle. Combined, the market maker move and the ADR today would get us below last week's low. That's at 39.06. I think if we get that close to the roundy, we're very likely going to just go ahead and tag the roundy. We can do the same thing from the other direction. So, from the close, that gets us to on the other side of the cog line on the upside. So 41.11 is a cog, and that would put us above it at 41.13. And it would be above the previous week's high. So we have the capacity today to leave that range that we were talking about. We're looking at a 10-day, 30-minute volume profile. And as I mentioned the other day, we're just about done with this data on the low end here. When we get through Thanksgiving and we come back on Friday, all of this lower area will be gone unless we break down today, right? If we just hold the line or we move up from here, then we won't have any of this background on the profile. And I mention it because when we're at the top, we say when we're at the top, we're going to go to the bottom. And when we're at the bottom, we're going to go to the top. Well, right now we're still in that top area. And we don't want to look down here at 37.58 and say, well, we're at the top. We're going to be working our way back down to this area, because we're very likely not going to be working our way back down to that area based solely on this profile. We can fall there because of the measured move. We can fall there because of the econ that comes out that sends the market lower. There's not a lot of support underneath the market once we get below 39.11, which is the cog line. We would be in a air pocket of risk. At that point, it's really shallow. There's nothing there. So a break below that 39.11. And if you just want some easy numbers, right, just call it 39. A break below 39 can easily send us to 38. There's nothing to catch us, nothing to support us, nothing to help us. There's no volume profile to carry forward, no point of control or anything like that. And we have now taken the 4018 VPOC off the table. We hit that this morning. The next one is a long ways away, so we don't have to worry about hitting that anytime soon. Yeah, on either side. So no profile, no point of control, value area, high and low. We don't have any of those to deal with. If it wasn't an economic event day, this volume right in here would certainly be worth focusing on if we were to start breaking to the downside. I say today it probably won't matter, because if the econ comes out and we send prices moving really quick, econ's just going to blast right through that. It is worth looking at, though, from yesterday. Think about the situation of how much time we spent there. We got into that topping pattern. This is one of my half-day wedge breakout strategies, right? You can find that if you just search through my YouTube, just type in half-day wedge breakouts, like a 2-minute video or a 5-minute video. Look at how much volume is there. It was almost where the point of control is at. So two really big areas of volume other than this one, because we spent a long time there. So it makes sense that there's a lot of volume there. But we didn't really spend a whole lot of time here, and yet there's a lot of volume. And look where the greatest amount of volume is. The greatest amount of volume out of yesterday was right there. That's where the point of control is. That's where the greatest amount of volume is. There was a massive amount of orders sitting up at that level. So the cool thing would be turn on something like TPO. We'll turn off the volume profile for a moment and turn on the TPO. You can see that we didn't really spend very much time up at the top, and we know that, right? I mean, it makes perfect sense. It was the end of the day. We ran up, got to that level, and went into the close. So we didn't spend, an extended period of time there, and yet that's where we had the greatest amount of volume. So it is a confirming, right? If you want some way to be able to articulate or confirm or validate the idea that there was a ceiling that we hit, right? Like if it was down below, it would have been an iceberg. It's over our head. It's a ceiling. We landed into a very large amount of contracts there. That's not theory. I'm not guessing or assuming that there was a lot up there. We can prove it because we got the volume profile and then we have the TPO. We can overlay the two on top of each other. Now you can see where the volume profile is and how much time we spent there. This is really hard to read. It's too much, right? That's why I don't tend to do that. All right, so a break to the upside today will get us very close to my monthly level marker. I've got a marker sitting at 41.38, 31.40, right around in there. I really don't see that we're going to make it past 41.38 today. No, I mean, you know, price can do whatever it wants, but if we look at the measured move and everything else, it would take an extreme bit of information beyond what we were already expecting to get beyond that monthly level today. For the downside, that market maker move is above my monthly level, but there is a quarterly level. We've chewed through that quarterly level so many times that it doesn't have any respect now. So price will go through that quarter really easy. But below that, we got a monthly level, 38.82. And then below that, we have a 50% mark from a measured move. It's from a really big candle, right? When we measure a big candle, mark the 50% mark. As long as we're holding above that 50% mark, this trend that we've been working on since early October is still valid, right? If we break below that, no, kind of takes that off the table. So really pivotal moment today, right? Big picture. So we're looking at the VIX here. I know it's a little rough getting zoomed in like this. There is a gap right now on the weekly time frame that we need to resolve. And it's very likely if we get this close that we're just going to keep going until we get there. 2074. The thing is, when VIX is going down, we kind of get that impression that, you know, it's bullish for the S&P. Until you look at it from the idea that once this gap is closed and VIX is no longer moving to the downside based solely on metrics, that it has the capacity to start moving up as well. Now, VIX is a formula, right? It's a math equation. So it's basically options volume. You know, at the end of the day, when you strip away all the nerd talk, right? It's just options on the SPX 30 days out. That's not the whole story. And the reason I'm bringing this up is if you are looking at today and thinking maybe you want a hedge, because, you know, the FOMC this afternoon, the minutes, FOMC minutes, has the capacity to really rock this market. And maybe you want a hedge, something like January or March. It's not a bad idea. Volatility is really low, right? Dollar wise, this is about as good as you're going to get for the rest of the year, probably. It might be worth buying a call, right? Because of the way that the VIX has been working this year, due to all the front end options trading, where, you know, 70-80% of the options volume right now is in the front expiration. So the VIX isn't working really good, which means you don't want to go out of the money a long ways and buy some cheap call out of the money, because that cheap call out of the money isn't so cheap. I mean, look at these. It's $200. That's not cheap. And you're basically throwing your money away. Unless we get another 2020 COVID style market explosion, this call isn't going to pay you anything. It would need to be that big, that explosive, that extreme. The thing is, think back all through this year, how bad things have been at different times. The VIX never got above 40. all year. It hasn't been above 40. So no matter how good the FOMC is the minutes today, no matter how good or how bad, it could be really, really bad. We're not breaking above 40. That call isn't going to activate and pay you really well if you get some far out of the money call. You're going to have to get right up in there and get something at the money. Now, the cool thing about the VIX is that these options don't go to the VIX once you're about 14 days, maybe 21 days away from expiration. So we're looking at 108 days out, right? We're looking at the March series. At the money is not VIX at the money. At the money is VIX futures March contracts at the money. So if you're going to trade an at the money option for March or January, bring up the VIX futures and then scroll down here and find March. At the money for March is 26.37. So if I wanted an at the money option for VIX for March, I could use those 26 options. That's at the money. Cool, cool. So we reached really, really low skew levels in the last month. Record-setting levels, right? If you discount this ghost print, which I would, right? I wouldn't use that. That should work. Normally, I don't get an error for trying to correct a bar. All right. So either way, that ghost print, if you get rid of it, we reached record lows never before seen, and we're finally starting to come up off of this. So we're going to start getting that skew smile back in there again a little bit if we can keep this moving to the upside. But it's got a lot of work to do. It's very likely not going to happen all at once, and it just takes time. But we're going to be looking for the curve in the options smile to start moving back away from the money. Here in the VVIX, this is like volatility of the volatility index. I call it the implied volatility of VIX, and it's not that, right? So I don't need anybody reaching out and telling me that it's not that. It's not that. But to try to explain what this is and to help people visualize what it is that we're talking about, just imagine that this is the implied volatility indicator of VIX. This is showing that we're in a low, that the VIX is not volatile right now. And that makes sense, right? It's not really moving around. It's the exact same reason that I said don't buy your calls really far out of the money, because you're very likely not going to get a lot of money for those calls. It's almost a waste of money. Trying to hedge with the VIX right now sucks. This is just confirming that the VIX is not moving around that much. So, all right, same names continue to pop up every day. Natural gas, Bitcoin ETF, KWEB, and on the downside, XLE, oil and gas, and then gold miners and gold, but it starts to drop off too fast, right? We wouldn't use those names. They're just not up enough or down enough. Benchmark is 0.5%. So energy getting really whacked today, at least so far. Keep in mind, we do have, energy data at 10:30, the petroleum status report. And if you look at the wild and crazy ride we had the other day in energy, the fact that we're down this morning, I wouldn't let that bias stick, right? Be ready for a change event. You can see how extreme the move was the other day. So be ready for some shenanigans today in energy. 10:30 is when the report comes out. So there's just a whole lot going on today. If you think about the S&P making that really big move that we were marking out, all of the major stocks that you could ever want to focus on are all very likely going to make a really big move today. So you could focus on, where are they likely to go, big picture, by the end of the day. Doing the same thing that we do every morning, right? Using ADR, measured move, market maker move, coming out and clearing all your pivot points and, giving clear signals of where you think that is going to go. Some of them matter more than others. So something that we've been talking about frequently is Apple. As long as Apple continues to hold the line, the entire market will not reset, right? We're all like waiting for this capitulation low. We're not going to get it if the market doesn't just straight up crash and burn. We need Apple to finally crash and burn to get that done. Now, Apple had some news last night. There was a little bit of a riot, it looked like, at their at one of their facilities in China. That's not necessarily the kind of news that we would be wanting to see, though, right? If we want this thing to crash and burn, we would want to see news like their iPhones are causing fires or something, right? That would certainly move the market. So if we get the econ this morning and Apple does break that 148 or the benchmark I've been using, 145.5, it could be the tailspin that finally gets this market moving to that capitulation low that we've all been looking for. But if the news is good today and Apple breaks that trend line to the upside, the rest of the market is going to run with it, right? Kind of everything just all gets put together like we've been talking about anyways. But these will be the tools that go with it, right? The Microsoft, Apple. Those are really the last two holdouts. But even the other big names from the monsters of tech moving in the upside or moving to the downside will be the fuel that keeps it going. Today's not going to be a grind like yesterday, right? When we finally get the news and the market starts to rock and roll, we won't have that problem of this thing not giving us signals. And we won't have the problem with the ticks not hitting in the extremes. Because today you're very likely going to have a high correlation coefficient. The good thing about having a high correlation coefficient is you don't have to be very particular about which stock you trade. I mean, think about it. If 499 names are all moving in the same direction, and there's only 501 names that you can trade in total, you would almost have to have the worst luck in the world to pick one of the two names out of the entire 501 that isn't working and try to trade it. Right? So you don't have to stress out about which one to trade. If we get into a high correlation coefficient, every single name on the list is all going to be moving in the same direction. At which point you want to get picky about the options, which ones have the better options to trade, and trade those, or which one has the better beta. Trade that. I hope everybody has a good holiday. Spend time with the family. Today's my anniversary, so we should have probably thought that out better when we were getting married, you know, that it was just a little too close to a holiday. But hey, you know, what could you say, you know, 18 years. And not that anybody's counting. So happy Thanksgiving, everybody. See you all on Friday. Please be careful today.